So, after years of lawsuits, SEC chaos, exchange crackdowns, and Congress mostly pretending crypto didn't exist, Washington may finally be doing something. Last week, the US Senate Banking Committee advanced the Clarity Act in a 15-9 vote, one of the biggest crypto regulatory developments we've seen since Bitcoin ETF approvals. And depending on who you ask, this is either the beginning of America becoming the crypto capital of the world, or the moment Wall Street fully captured crypto. Because the Clarity Act could fundamentally change who regulates crypto, how tokens are classified, whether DeFi survives in the US, and whether exchanges like Coinbase finally get legal clarity. But the bill isn't law yet, and the fight inside Congress is getting messy. In this video, we're breaking down what the Clarity Act actually does, why this recent markup vote matters, who's lobbying for it, who hates it, and what it could mean for Bitcoin, Ethereum, XRP, altcoins, and crypto investors globally. Be sure to subscribe to my personal trading channel for full crypto tutorials with everything you need to know to build a rounded, full trading plan. From strategies to indicators and even including beginner content on price action candle reading. Be sure to put on the notifications there for the new content and the live trading streams. That link is in the description, along with the link to our Discord community where I am dropping my own personal TA throughout the week, and our community members are dropping their trading setups every single day and trading together and learning from each other. We can see by the P&L share group that the crew is absolutely killing it using our strategies. Before getting into the vote and what's next for the act, let's break down what the Clarity Act actually is. At its core, the Clarity Act is trying to answer one question. What actually is crypto? Because right now, the SEC basically argues most tokens are securities, meaning exchanges should register like stock exchanges. Token issuers should comply with securities laws, and projects can get sued retroactively years after launch. That approach created the infamous regulation by enforcement era under Gary Gensler. The Clarity Act changes that by creating a new category called digital commodities. And that's huge, because instead of the SEC controlling most crypto, the bill would shift much of the market under the CFTC, the Commodity Futures Trading Commission, the same regulator that oversees things like oil, gold, wheat futures, and derivatives markets. The crypto industry generally prefers the CFTC because it's viewed as a lighter touch, a more innovation-friendly and less aggressive than the SEC. The bill also introduces something called Regulation Crypto, which creates a tailored fundraising framework for token projects. Instead of forcing blockchain startups into 1930s securities law, Congress is attempting to build a crypto-native framework, which is a wild concept. So let's talk about now why this vote matters. Technically, this wasn't the final vote. It was a committee markup. That means senators debated amendments and then voted on whether the bill should advance towards the Senate floor. But this vote mattered for three reasons. First, the bill had already collapsed once before. Back in January, lawmakers delayed the markup after 100 amendments triggered chaos behind closed doors. Second, this time the bill passed with bipartisan support. That's important because crypto legislation in the US usually dies the second it becomes politically polarized. And third, markets reacted immediately. Bitcoin jumped, Coinbase shares rallied, and crypto miners pumped, because investors interpreted the vote as a sign the US might finally establish actual rules instead of endless lawsuits. Now, to be clear, the bill still needs a full Senate vote, reconciliation with another Senate committee, reconciliation with the House version, and a presidential signature. So there are still plenty of ways that this could implode. But for the first time in years, there is momentum. Now here's where things get spicy. The biggest fight around the Clarity Act isn't actually Bitcoin, it's stablecoins. Specifically whether crypto companies should be allowed to offer yield on stablecoin balances. Of course, banks absolutely hate this idea because from their perspective, if Coinbase can offer yield on digital dollars without the same banking regulations, then why would people keep money in savings accounts? And that's a legitimate concern. But crypto companies argue stablecoin yield isn't banking. They say it's simply sharing treasury income generated by reserves backing those stablecoins. And this matters a lot because stablecoins are becoming one of crypto's biggest real-world use cases, especially in terms of payments, remittances, on-chain finance, and tokenized assets. The banking lobby reportedly pushed hard to limit these yield products. And this disagreement is actually what delayed the bill earlier this year. So despite the positive headlines, the stablecoin battle is far from over. So who benefits most if the Clarity Act actually becomes law? Well, first, US crypto exchanges. Coinbase is the obvious example because instead of operating in a legal gray zone, they'd finally know which assets they can legally trade, which regulator oversees them, and what compliance framework applies. Second would be the institutional investors, because big money hates uncertainty. Clear rules could massively accelerate tokenization, ETF expansion, custody services, and bank participation. Third are certain altcoins, especially projects that have spent years fighting the SEC narrative that they're securities. That's why XRP traders are watching this bill so closely, because if tokens can formally qualify as digital commodities, it changes the legal landscape dramatically. And finally, DeFi might benefit too. The bill includes protections for validators, node operators, and certain decentralized activities that don't involve custodying customer assets. Now, obviously, not everyone thinks this is good. Critics argue that the bill weakens investor protections, gives too much power to the CFTC, and opens loopholes for risky crypto products. State regulators are also worried that federal law could override local enforcement powers. And interestingly, some crypto people hate the bill too. Cardano founder Charles Hoskinson reportedly called parts of it a trash bill, because he believes that some provisions could hurt DeFi developers. There's also a political layer here. Some Democrats attempted ethics amendments related to political figures profiting from crypto businesses. Those amendments failed during the markup. So beneath all of the crypto regulation headlines, this is also becoming a banking fight, a Wall Street fight, and increasingly a partisan fight, which means that the path ahead could get ugly. So where does this go from here? Well, the next step is a full Senate vote. Then lawmakers need to reconcile multiple versions of the bill between committees and the House. And they're racing against the political calendar because once the 2026 midterm season fully kicks off, controversial legislation becomes much harder to pass. But regardless of whether the Clarity Act survives in its current form, one thing is obvious. America is finally being forced to decide what crypto actually is, not just as a technology, but as a financial system. And honestly, that decision could shape the next decade of global crypto adoption. Because if the US embraces crypto with clear rules, capital floods in. If it fumbles this, innovation probably moves elsewhere. If you enjoyed this breakdown, hit subscribe, leave a like, and let us know in the comments, is the Clarity Act bullish for crypto, or is this just Wall Street taking over the industry?